Hello friends, last week I warned you that volatility was likely to shoot up very sharply, and volatility did spike up. And how? I saw standard deviation, which is a measure of volatility in many stocks, rise by 50% more than the average of many quarters. That's the kind of volatility spike that I saw last week, and frankly, this is not really a very healthy sign. Although at points where the market reaches new highs, weaker hands tend to exit stocks and stronger hands tend to get into those stocks. But they want to buy low and sellers want to sell high. So normally there's a lot of give and take, push and pull in stock prices, which is fair. But this was still above average. Now, what I'm basically trying to discuss in this video is, are the bulls appearing tired? Volatility apart, is there any sign of fatigue in the bull camp, or is the market going to shrug off the weakness and continue to rally higher? Do remember last week I pointed out to you that bulls are over leveraged because MWPL is at multi-month highs, and that I told you would result in higher volatility. Does it mean that bulls will start unwinding, and that unwinding, which will be substantial, could bring the markets lower? That's what the crux of this video is. And let's dive right in, and on your screen right now is the market roundup window. The market roundup window on your screen tells you that it was the bank Nifty which led the declines, and the broader based Nifty 50 followed the bank Nifty on the way down. The US dollar index, or the Dixie, rose 25 basis points, and that exerted downward pressure on emerging markets, including commodities. And you're seeing gold fell marginally, whereas silver rose a little over 1.5%. Crude and natural gas fell due to a strong dollar. And like I said, in spite of the output cuts, man-made artificial shortages, and the hurricane season, I have been telling you on my Telegram channel that upsides are likely to meet with selling pressure. Also remember, there is appearing to be a solution to the Australian labour strike at the Chevron plants. The 10-year benchmark bond yields fell 2 basis points, which means bond prices went up. That cushioned the fall a little bit on the bank Nifty. NSE lost 1.75% market cap on a week-on-week basis. Now that's big, which means the selling was broader based, and that could be a sign that bulls are appearing a little tired as of now. The USD INR fell 24 basis points, which means the rupee actually strengthened against the dollar. Partly it could also be because of the reported RBI intervention in the forex markets. The US markets fell across the board, and all three indices were in the red, and that provided headwinds to the domestic markets. I now come to our in-house indicators, starting with the MWPL, or market-wide position limits. This is the extent of limits utilized by traders as a percentage of limits allowed by SEBI. What you are seeing is in the third week after expiry, the MWPL is at 38.43. Although it has risen over the prior week, but the gains are now slowing down. So risk appetite has begun to taper off. Now, whether this is a temporary phenomena or bulls will come back at lower levels and support the markets, time will tell. But unless the MWPL picks up, I would say that the bulls are showing some signs of fatigue. Normally, MWPL tapers off in the week of expiry. It basically climbs up to Monday and Tuesday of the expiring week, but this time around tapering off has started a little early. A small red flag here. Let's now see the individual stock futures and index turnover. This is 3 concurrent series, so this is September, October and November. Do note, last week was shorter by 1 trading session, and therefore volumes will appear to be marginally lower. And in a falling market, volumes do tend to fall a little bit. Now let's see the advanced decline ratio, which measures the buying conviction of intraday traders, and advanced decline ratio is now at 0.70, which means for every 100 losing stocks, there were only 70 gaining stocks. This is the second lowest advanced decline ratio reading in the last 5 weeks in the 20-week period covered by this chart. So that tells you that buying conviction was fairly poor. The red line shows the percentage loss by the Nifty on a week-on-week basis, and this is the biggest loss at 2.57% in the 20 weeks covered by this chart. So bulls clearly appeared to be on the back foot, but this chart needs to be watched on a daily time frame basis, which I update on my social media accounts. Do take the effort of connecting with me over there. Now for the Nifty and Bank Nifty prompt futures basis. Now basis is nothing but the premium or discount prevalent in the futures compared to spot. Basis tends to compress as markets approach expiry, just like options premium, but it also is dependent on short covering or short selling. What you are seeing is the Bank Nifty basis went up from 56.55 in the prior week to 65.55 last week. So there was some short covering at lower levels. The Nifty 50 is shown as a blue line, and the basis fell to 34% from a prior week of 57.25. That tells you that there was fresh selling on the Nifty, and two Marshmallow traders have been pressing shorts on the Nifty. So that is a sign that selling pressure is continuing. Let's now go to our exclusive in-house indicator, the impetus. You won't find this anywhere on the internet. And impetus reading was lower. Do remember, last week both the indices have fallen. The fact that the falls have come on falling impetus tells you that the selling was not as forceful as something that you could really lose sleep over. This was more of a fall being triggered by gravity and prices sliding down rather than heavy duty slam dunk sell-off. So as of now, you could see some cushion coming in, provided the impetus does not rise with falling prices. Friends, I now come to the LWTD indicator, another exclusive in-house indicator that you won't find on the internet. You are seeing the blue line, which is the Nifty's percentage gain or loss, is the biggest 1 week loss in the 20-week period. The LWTD has risen from minus 0.07 last week, prior week, to 0.31 last week. So what does it tell you? That the price is indicating downsides, but the LWTD indicates that there could be a possibility of short covering at lower levels. Now, it's not really rocket science here. The coming week is an expiry week where traders tend to square up their positions. And last week, obviously, there's been a lot of short selling. So before expiry, there could be squaring up of some shorts. Friends, our in-house indicators done. I now come to the bond markets. Now, do remember, we have been at the forefront of the market analysts and market watchers community by analyzing bonds ahead of equities and commodities and currencies in our reports. The reason is that we feel bond markets fuel the prices of other asset classes. And do remember, almost a year and a half ago, I have been telling you that Indian bonds have a chance of being listed in overseas debt indices, and therefore there could be inflows coming in from overseas investors into our debt markets. And sure enough, there is a possibility, a very strong possibility, that in 2024 or 25, you could see Indian bonds being included in the bond indices maintained overseas. And sure enough, you saw the 10-year benchmark, Indian benchmark bond yield fall 2 basis points. It's the second consecutive week in a row that this bond yield has seen declines, because dealers were expecting overseas investments into the bond prices, and therefore bought in anticipation. Now, what does it mean for us? Do remember we've laddered all the way up to 7.5%. We've started from 6.6 and gone all the way up to 7.5%. And right now, I would say let's wait and watch. I would ladder sovereign yields only if they cross 7.5%, and I would go for gilt funds only if the yields fall below 7% and stay below. I have updated my Telegram channel, which is absolutely free. Do connect there, and I will be, I assure you, putting in an update about when you should be going in for gilt funds. Friends, the bond market's done. I now come to the Bank Nifty. This led the way down, and it fell by 3.5% on a week-on-week basis. The daily chart on your screen shows you that this index fell on all 4 trading sessions of the week, and the price has fallen below its month-long moving average, which means the short-term outlook has turned mildly cautious because recent buyers are now required to pay mark-to-market losses. The month-long moving average itself is turning slightly downward, so there could be some more selling possible. The head and shoulder that had formed from June 2023 onwards and was overcome in the last fortnight or so threatens to get back into activation mode if the 44,400 level is breached on a sustained closing basis on the Bank Nifty spot. 44,152 level is the previous level that I have marked with a dotted blue line, which is a support to watch out for. Turning to the weekly chart, you can see that there's a bearish power candle. What's a power candle? It's a large bodied candle where a big amount of price movement has occurred. This has basically wiped off 2 prior weeks worth of gains made on the Bank Nifty. Mercifully, the price is still above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook still remains optimistic for now. It's only if this moving average and the previous swing high made across this moving average, only if it is violated on a sustained closing basis, that you should really feel that bearishness could be anticipated. In the week before last, this index was number 3 on the most volatile counters list maintained in-house by us based on statistical beta metrics. It remained at number 3 itself, so it was unchanged. Challenge level remains high. Last week, I advocated an anticipated range between 47,350 on the upside and 45,125 on the downside. It logged a low of 44,549, so it exceeded my support level fairly prominently due to the high volatility. In the coming week, I anticipate an estimated range between 45,750 on the upside and 43,475 on the downside. I would advise you to remain cautious and trade light. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 2.5% on a weekly basis and fell on all 4 trading sessions, as the daily chart on your screen tells you. Just like the Bank Nifty itself, the price is below its 25-day exponential moving average, which has turned sideways. Now, if you were to take the rally that started from the middle of August and peaked out last week, the decline that has occurred is exactly 61.8%, which is a Fibonacci golden ratio. So if the bulls don't really manage to push prices higher soon enough, they could witness more weakness ahead. Do remember, the coming week is an expiry week, so there'll be a lot of pull and push. We would want the market to go up if the bulls are not to confirm that they are tired of buying afresh. Coming to the weekly chart, what you are seeing is that the price has again, like the Bank Nifty in the previous chart, it's made a bearish power candle. But it's not yet wiped off 2 consecutive weeks of declines. And secondly, it is way above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So relatively speaking, the Nifty appears to be better than the Bank Nifty, where relative strength is concerned. The 18,887 is a near-term support to watch out for. Friends, in the week before last, this index was number 6 on the most statistical beta-based volatility list. It fell by one notch to number 7. Not because volatility fell, but because individual stock volatility, relatively speaking, went up faster than the Nifty 50. The challenge still remains. Last week, I advocated an estimated range between 20,575 on the upside and 19,825 on the downside. The downside was violated because the low was 19,658. In the coming week, I anticipate a range between 20,050 on the upside and 19,300 on the downside. Friends, I now come to the last bit of statistical data analysis which I share with the footprint of the traded turnover that retail segment notches up in the 4 derivative segments of the market. And what you are seeing is that futures have seen higher turnover. Where index futures are concerned, which is indicated by a blue line, there was a 3 basis point increase in turnover percentages. And where stock futures turnover are concerned, here again, a 3 basis point increase was seen, shown as a red trend, a red line. Where options turnover is concerned, the index options, which are the safest and lowest cost instrument where margin requirements or premium requirements are concerned, saw the turnover fall the sharpest. The violet color line is the stock options turnover percentage, which saw a robust rise. So, sure enough, risk appetite remained. Traders were participating more in futures, which require a higher span margin. But also remember, this is the pre-expiry week. You are basically squaring up your positions in September futures and reinitiating those positions in October futures. So the turnover recorded can be double. So just before expiry, percentage turnover clocked by futures does tend to go up. So we need to take this data with some amount of adjustment factor for it. But overall, the fact that stock options turnover was higher than index options turnover tells me that risk appetite still remains. So even though the bulls may be a little cautious, don't write them off as yet. The bull market is not yet completely off the table. Friends, I now come to what I would do in the coming week. Now, I have been telling you that I would focus on PSUs for almost 2 months now. That logic still remains in place. Why change a winning formula as long as it is yielding results? As long as results are yielded, I would continue to trade PSUs. I'm not talking of direction. I'm talking of sector trades, because price volatility is likely to be bigger. You as a trader are likely to get wider price ranges to trade the market. If oil prices were to go up, oil marketing companies' stock prices will continue to remain subdued, which has been the trend in the last couple of weeks. I also think that FMCG sector might just see exaggeratedly bigger price movements in the coming week if my estimates are correct. Now, here again, the direction of the trade will be determined by the snap quote window as to which way the market is going. But the FMCG space appears to be another area which you can watch. Metal stocks might just see higher than average volatility due to the higher volatility present in metal prices on the commodities exchanges. Gold and silver are something that I would continue to watch because Diwali season is approaching and pre-Diwali stocking up by wholesalers and retailers should start pretty soon, if not started already. And as far as oil and gas prices are concerned, I would basically want to play out the theta decay options in the derivative space, but the natural gas series are coming to an expiry at the end of this week, whereas oil markets have already seen, oil futures have already seen expiry last week. So you have better chance in the theta decay in crude oil, WTI grade crude oil on the MCX. Friends, overall, I would suggest you trade light because volatility is likely to remain high. Are the bulls completely tired, ready to give up? I don't think so. But are they appearing cautious? Definitely so. This is a time to be cautious. I thank you for staying with me in this video till we meet again in my next video. This is Vijay Bhambwani signing off for now, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so, and click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos are helping you become better traders, and hey, share my videos with your family and friends. I wish you have a profitable week ahead. Take care. Bye-bye.